Welcome back to Talk Tickers. Today we are cracking open the hood on a company that really acts as the ultimate thermometer for the American white-collar economy.
Oh, for sure.
We're talking about Kforce. And if you're sitting there thinking, why do I care about a staffing firm? Well, you need to pause that thought.
You really do.
This isn't just about temp jobs. This is a direct read on whether the tech and finance sectors are actually hiring people or if they're just, pretending to.
It's one of the few pure plays we have to gauge the actual temperature of the labor market. And to be honest, this particular deep dive into their Q4 2025 results was a bit of a psychological thriller.
It really was.
It wasn't just some boring staffing print. It was a battle between volume and profitability.
It was a paradox. Kforce just delivered what they are calling their best sequential growth numbers since the glory days of 2022. I mean, management is practically doing cartwheels in the transcripts.
They sound thrilled.
But then you look at the market reaction. The stock gaps down 8% at the open and settles down over 2.5%. That is a nasty reception.
It's that classic good news is bad news disconnect. The market looked at the report and saw one thing, while management looked at the same report and saw something completely different.
So our mission today is to parse that disconnect. We need to figure out why investors hated a revenue beat. And the bigger question is, is this frozen labor market we've been hearing about finally thawing, or is it just getting more expensive?
To understand that, we have to start with the headline numbers. This is where the tension really begins.
Okay, let's hit the snapshot. Top line revenue came in at $332 million. Now, the consensus on the street was looking for around $328 million.
So that's a beat.
Strictly speaking, that's a beat. They brought in more cash than expected. That usually sends a stock up. But then you look at the bottom line. GAAP earnings per share, just 30 cents. The street was expecting 47.
That is a massive miss. I mean, we are talking about missing the profit target by almost 35%.
And even if you look at the adjusted EPS, which, strips out the ugly one-time charges and is usually the number management wants you to focus on, they came in at 43 cents.
Which was below the midpoint of their own guidance range. So you have a revenue beat, but a pretty bad earnings miss.
Exactly.
Okay, let's unpack this immediately because this is the part that drives me crazy.
Indeed.
If I run a lemonade stand and I sell more lemonade than I plan to, I usually make more money. How does a company like Kforce beat on revenue, sell more product, but miss so badly on profit? Where did the money go?
It's the classic margin crunch. Gross margins dropped 50 basis points sequentially to 27.2%. Now, 0.5% doesn't sound like a lot, but in the staffing world, that is a ton of friction.
It really is.
And when you dig into the transcript, management pointed to a few specific culprits. First, higher healthcare costs. Apparently, their consultants got sick or needed more care than planned.
Okay, that happens. But the second one is the one that really annoyed investors. Performance-based compensation.
Wait, performance-based compensation just means bonuses, right? So they paid out more bonuses.
Exactly.
Yeah.
Because the sales teams hit those high financial targets on the top line, that revenue beat we just mentioned. So the bonus pool triggered.
Hold on a second. So the sales team did a great job bringing in revenue, so they got a bonus. But the bonus was so big that it caused the company to miss its profit target. That feels like a glitch in the matrix.
It feels like a misalignment of incentives, doesn't it?
Right.
They achieved the volume target, which triggered the payout, but the quality of that revenue just wasn't high enough to absorb the cost of the bonus.
Wow.
Plus, they had a lower mix of direct hire revenue. Direct hire is when a company pays Kforce a headhunter fee to find a full-time employee. That's almost pure profit.
And that segment was down, so they were doing a lot of lower margin work and paying high margin bonuses to get it.
In a nutshell, yes.
Yeah.
And that completely explains the market reaction. That gap down tells us that right now, investors care way more about the quality of the earnings. They wanted profit protection.
And instead, they got expense bloat.
Exactly. Operating margins were razor thin, 2.6% on a GAAP basis. I mean, that is perilously close to just breaking even.
That is razor thin. If you sneeze, you lose money at 2.6%. But here's where it gets really interesting, because despite the market slapping them on the wrist for the margins, management was shouting a very different narrative.
Oh, yeah.
They kept using this phrase, best start since 2022.
That was the key theme from CEO Joe Liberatore. He's looking at the calendar in January 2026 and seeing momentum they just haven't seen in years.
Right. They mentioned that tech flex revenue, that's the contract tech workers, grew 3% sequentially. And finance and accounting flex grew almost 6% sequentially.
And for the listener who doesn't stare at spreadsheets all day, sequential matters so much more than year over year right now.
Why is that?
Because year over year comparisons are looking at the past. I mean, 2024 and 2025 were brutal. So if we compare today to a year ago, it still looks bad.
Of course.
But sequential means month over month or quarter over quarter. It shows the current trend. It shows the bleeding has stopped and the patient is, waking up.
And it wasn't just the revenue numbers, it was the behavior. They said clients are back to visiting, interviewing, and ordering. They explicitly said front-end indicators, the stuff that happens before a hire, are at the highest levels in firm history.
And this is where we need to connect this to the bigger picture. Why now? Why are clients suddenly waking up? The CEO laid out a really compelling thesis involving AI and the macro environment that explains this thaw.
This is the AI versus macro debate. This was my favorite part of the call. Break that down for us.
So think about the mindset of a CTO or a CIO for the last 2 years. The labor market has been frozen. Companies were paralyzed.
Totally.
On one hand, they didn't want to hire full-time employees because everyone was terrified of a recession. But on the other hand, they were paralyzed by the promise of AI.
The AI pause. They thought, why hire a Java developer for $150,000 a year if ChatGPT might do it for free next year?
Precisely. They were waiting for the miracle. But now, according to Kforce, we are hitting a massive reality check. Clients paused hiring to figure out AI, and what they're realizing is that AI returns take longer and are, frankly, harder to get than they thought.
It's not a magic switch you just flip.
No. It requires clean data, security protocols, and massive integration work. The sci-fi dream is hitting the messy reality of corporate IT infrastructure.
I can believe that.
The CEO actually referenced a Gartner report that basically said humans plus AI is greater than just AI. And he mentioned a Wall Street Journal article about the disconnect between CEOs who think AI is making everything efficient.
And the employees who are drowning in rework and trying to fix what the AI broke.
You saw that one.
I did. It's the AI hangover. You spend half your day prompting the bot and the other half fixing the code it wrote.
So the consequence of this realization is fascinating for a company like Kforce. Companies are realizing they still have work to do. They can't wait for the AI miracle anymore. The backlog of projects is getting too big.
But, and this is the key, they are still scared to commit to full-time employees because of the macro uncertainty. They don't want to add fixed costs.
Exactly. So what do?
Rent.
They rent. They use flexible talent contractors to bridge the gap. That's why Kforce is seeing this surge in volume. It's not that companies are confident enough to marry their employees. They just want to date them.
That's a great analogy. It's a commitment-phobic labor market. We need this code written, but we aren't ready to offer you health insurance and a 401k.
Correct. And Kforce is the landlord of that market.
But let's look at how Kforce is actually operating within this. They aren't just sitting back and letting the orders roll in. They're actively cutting costs, too. Because remember, their margins are terrible right now.
Right. Despite the optimism on volume, they are being disciplined on cost. They took charges in Q4 to refine their headcount, meaning they laid off some of their own internal staff.
Okay.
They expect about $7 million in annualized savings from those cuts. That's roughly a 30-cent per share benefit going forward.
Which, ironically, is exactly the amount they missed by this quarter. It feels like they're trying to engineer the profit back into the business.
They are. And part of that engineering is the One Kforce strategy. They're integrating sales and delivery, but the big lever they are pulling is the offshore push. They talked a lot about their development center in Pune, India.
Now, usually domestic staffing firms brag about their onshore presence. We're American-based, we understand your culture. Why is Kforce leaning so hard into India?
It's a necessity now. They called it a multi-shore delivery model. Clients want the work done, but they are incredibly price sensitive. If Kforce can deliver the talent from India at a lower cost, it keeps the client happy and it keeps the project moving.
But let's talk about the math of that. Because if they're moving work offshore, does that hurt their pricing power? I assume you can't bill $90 an hour for a developer in Pune.
It's a balancing act. The tech bill rate has been steady at around $90 per hour.
Yeah.
That's been flat for 3 years, which is actually kind of impressive given the deflationary pressure.
And finance and accounting.
About $53 an hour, which is actually an improvement year over year. But the shift they're really trying to make is toward consulting solutions.
I hear that buzzword a lot. Solutions. What does that mean in plain English versus just staffing?
Staffing is, here's a resume, you interview him, you manage him, we just pay him. Consulting solutions is, you have a project to migrate to the cloud, We'll take care of it. We will provide the team. We'll manage the timeline. We will deliver the result.
Okay, so it's higher value.
It is. But here's the catch that confuses the numbers. As they mix in more offshore talent from India into these solutions teams to keep the price competitive, it naturally lowers the average bill rate. So the top line revenue per hour might drop, but the margin, the profit they keep, might actually go up because the cost of labor in India is lower.
So they have to sell more hours to get the same revenue, but they keep more pennies on the dollar.
Exactly. It's an arbitrage play.
Got it. And they are also implementing their own internal tech stack to help with this, right? You mentioned Workday.
They did. But investors shouldn't hold their breath for a quick payoff there. Management was pretty clear that significant benefits from the Workday implementation won't be realized until post-go live in 2027.
2027. In the world of AI, 2027 might as well be a century from now. Okay, let's look at the immediate road ahead. They gave guidance for Q1 2026. What does the next 3 months look like?
They guided for revenue of $324 million to $332 million. And EPS guidance is 37 to 45 cents.
That seems fine, stable, but there was a nasty surprise in the fine print regarding taxes.
Yeah, this is a headwind that nobody likes. The effective tax rate is jumping to 29%. It's usually around 26%.
Why is the government taking a bigger bite all of a sudden?
It's actually due to that Workday project we just mentioned.
Wait, how does a software project raise your taxes?
It's about R&D tax credits. Because Kforce is spending less on the Workday implementation right now, maybe pausing a phase or something, they have less research and development expense to claim tax credits against.
So, because they are saving money on the project, they're losing the tax coupon and their tax bill goes up.
Yes.
That is the most corporate catch-22 I've ever heard. We saved money on development, so now we owe the IRS more money.
It's a direct hit to EPS. But despite the tax hike and the margin squeeze, they are still handing cash back to shareholders. They returned $14.1 million in Q4, about half in dividends, half in buybacks.
And the board approved another dividend increase, which makes it the 7th consecutive year.
It does.
That signals confidence, at least. You don't raise the dividends 7 years in a row if you think the ship is sinking. So let's synthesize the signal here. What is Kforce betting on?
They are betting that the Great Resignation hangover is finally over. They believe a cyclical recovery is starting. The CEO made a fascinating comparison to the internet boom of the late 90s.
The dot-com era.
Yes. He drew a parallel. He said with the internet, you had massive infrastructure investment. First laying the fiber, building servers, setting up networks. That was good for Kforce's data and digital practice. Then, years later, came the transformation where businesses actually changed how they worked.
And he thinks we are in the infrastructure phase of AI.
Exactly. He thinks we are in the plumbing phase. Companies need to clean their data, move to the cloud, and secure their networks before they can use the fancy AI tools.
So lots of plumbing work before the shiny apps take over. That makes sense.
That's their bet.
But here's the risk, and it's why the stock dropped. Investors are skeptical because the conversion rate is down.
That's the rate of contractors becoming full-time employees.
Right. Why is that a bad sign? I would think Kforce wants to keep them as contractors forever so they can keep billing.
In the short term, yes.
Yeah.
But if the conversion rate is down, it means clients are treating labor purely as a variable cost. They aren't investing in people, they're renting them. If the economy dips even a little bit, if we get a whiff of a recession, those contractors are the first distinct expense to be cut. It makes Kforce's revenue quality feel a bit more fragile.
It's volatile revenue versus sticky revenue. Okay, that frames it perfectly. So we have a revenue beat, a profit squeeze, a frozen market that might be melting, but only for temps, and a tax hike.
That's the landscape.
All right, let's pivot. We've looked at the past, we've looked at the guidance, now it's time for our favorite segment.
Let's hear it.
It is time for, this is not financial advice. This is where we pitch a trade idea that is wild, potentially dangerous, but grounded in the reality we just discussed.
And please, listener, do not actually do this with your retirement money. We are just two voices in your headphones.
Proceed with extreme caution. What's the pitch today?
I'm ready.
I call this the AI purgatory arb.
The AI purgatory arb. Okay, I'm listening.
Here's the thesis. Corporate America is paralyzed. We just heard it from the CEO of Kforce. Executives are too scared to hire humans because they think AI might replace them next year.
Right.
But they are too incompetent to actually deploy AI because their data is a mess and their employees are revolting against the rework.
That is a harsh, but frankly, a statistically accurate assessment of the current state of affairs.
So they are stuck in purgatory. They can't move forward. They can't go back. So who wins in purgatory?
The landlord of the waiting room.
The landlord of the waiting room. And that's Kforce. You go long Kforce, ticker KFRC. Why? Because they provide the flexible labor, the temps, that companies use when they are terrified of commitment. Kforce is selling the bridge to nowhere, or at least the bridge to eventually.
Okay, so you're long the staffing firm because they profit from indecision. What's the other side of the yard? What are you shorting?
You short the pure play AI hype. You find a company that is selling AI tools with absolutely no revenue, the ones promising that the revolution happens next Tuesday.
So you're betting against the miracle and betting on the mess.
Exactly. And here's the kicker. The market just punished Kforce for spending money on healthcare costs and bonuses. That is temporary noise.
It is.
But the volume of work is skyrocketing. Best start since 2022. You buy the dip on the plumbing of the labor market while everyone else is still chasing the sci-fi dream.
You know, there is a certain logic there. If AI adoption is slower than expected, which management explicitly said, then the bridge technology, which is human contractors, stays employed a lot longer than the market thinks.
You're betting on corporate inefficiency?
I am betting on the enduring power of middle management indecision. It has never failed me yet.
It's usually a pretty safe bet.
All right, let's wrap this up. Recap the key takeaway for the listener who might have zoned out.
The headline is, revenue beat, margin miss. But the real story is that the frozen labor market is melting, but it's melting into a puddle of contractors, not full-time hires.
And the final thought?
Watch the consulting solutions mix. If that grows, margins expand and the stock works. If that stalls, they are just renting bodies at lower margins and the profit squeeze continues.
There you have it. Thanks for listening to Talk Tickers. Don't blame us if you lose money.
But do blame us if you learned something. See you on the next print.